Hey everyone. One of the most important drivers of commercial real estate demand is population growth. And when I speak at events, I often show a map with the metro level population growth forecast. It's a great way to provide scale and context to help investors contrast different metros across the country. And when I show that slide, investors often lock in on the strongest growth markets as a jump-off point for their investment strategies. And aligning with that, there has been a distinct increase in the flow of capital to the strongest population growth markets. Those are mostly in the Sun Belt, including the Southeast, the South, and the Southwest, but the two main markets in the Mountain States, Salt Lake City and Denver, are also up there. If you look back to 2010, these states comprised about 21% of the total commercial real estate sales dollar volume. By 2019, the dollar volume share going to those states was up to 27%. Then, as we went through the pandemic and southward migration surged, this region's share of commercial real estate dollar volume pushed up to the 34% range. That wave of capital was a significant factor driving down Sunbelt cap rates in 2021 and 22. Then, as the Federal Reserve raised interest rates last year, the transaction flow ebbed, and the share of investment capital to the Sun Belts receded to about 31%. My point here is that capital has been following the population. So when I show a map with the big green dots on it, I think some investors are actually seeing giant bullseyes. But I have to remind investors that there's a lot more to the equation than just finding the fastest growing metros. There are markets that have fantastic growth on a macro level, but still have significant local nuances that drive performance and opportunity. By the same token, investors often look past metros that have weaker macro level indicators, and as a result, those investors miss out on opportunities. To give you an example, think about San Francisco. These days, the media is focused on how hard the urban core has been hit, especially office properties. And on a macro level, those numbers don't look good. The average office vacancy rate for the San Francisco metro was 8.9% at the end of 2019. That's before COVID hit. Since then, that vacancy rate has surged to 23.6% as of the first quarter of 2023. Contrary to the metro level trend, the office vacancy rate in the North San Mateo County submarket, which includes the city of South San Francisco, is just 7.7%. In addition, the average office asking rent in that submarket is up by about 39% from the fourth quarter of 2019. Now that's a bit of an extreme case, but another market that has run into some challenges is Portland, Oregon. Again, the population growth numbers for Portland haven't been that great. In fact, the city of Portland has lost population over the last couple years. And if you look at the apartment vacancy rate for the metro, it's a bit soft, up about 70 basis points from the fourth quarter of 2019. But if you drill into some of the suburban submarkets, you'll see a different story. The apartment vacancy rate in the Hillsborough submarket is 70 basis points lower in the first quarter of 2023 from the fourth quarter of 2019. The Southwest Portland submarket also has a lower vacancy rate, and the Vancouver submarket vacancy rate is flat compared to 2019. So I encourage investors not to overlook opportunities just because the macro level numbers suggest the market isn't performing well. By the same token, there are some markets that have really strong macro level drivers, but they still may have poorly performing submarkets. For example, the city of Austin has some of the strongest growth metrics of any city in the country. And the metro's average retail vacancy rate is a record low 3% as of the first quarter. That's down 110 basis points from where it was before the pandemic. But there are a couple of Austin submarkets where the retail vacancy rate today is 100 to 200 basis points higher than they were in 2019. Another top performing growth market is Orlando. But in the last 3 years, the apartment inventory in that metro has grown by close to 11%. So while the metro apartment vacancy rate has only gone up by about 80 basis points, there are some submarkets where that vacancy rate has gone up by double, about 150 basis points or more. So here's my point. Investors can and should closely evaluate the macro trends. Consider population growth, job growth, household formation, income levels, and all the other major metrics. But investors also need to dig under the surface. As a friend of mine says, use a shovel, not a rake. And don't toss out markets just because they have weak macro level numbers. They could still have outperforming submarkets and assets. Yes, I'm cherry picking data for this video, but isn't that what investors should be doing? Cherry picking the best of the best. Dig under the surface, but remember, keep your eyes on the horizon.